Trade Genius.
Hey guys, welcome back to another episode of the Trade Genius podcast. Joining me today is Bob Kudla as always. And so, Bob, what are we diving into today?
Yeah, I thought we talked two things here. One is I wanted to just kind of complete this whole Fed thing that we've been preambling on here for the last couple of days because it's kind of an important week for Fed information. And then Phil, you have a couple things talking about bear market, some data points on that, and then with that, I'm also going to talk about what happens with the stock market and inflation. It's kind of counterintuitive, and I thought it'd be interesting to see what the data shows you. So those are the things, guys. We're going to strap in for about 20 minutes, and we'll get rolling here.
All right, very good. All right, I guess we'll dive into the first chart here. So let's bring that up. All right.
Yes,
And
yeah,
what are we looking at
sorry.
here?
Yeah, so this is like my final thing on the Fed. So when we talked about, when the Fed's going to stop, as you could see, as the Fed creates these bubbles, they can only raise Fed funds rates so far before they have to collapse the Fed funds rate. And this look at this last one. I mean, it's barely a blip. It feels painful because from a percentage basis, it's very, very, very profound. But from an actual nominal sense, it's we're nowhere near the last bubble that they had a pop. And so my expectation is obviously they're getting close to the end. Whether they want to or not is irrelevant because they're going to create. They're basically at the top of Sisyphus right now. So they got the rock up there, and they know the rock can't stay there. So they're at the point where they're going to probably have to roll this thing down and take the inflation medicine versus taking the deflation medicine. When you get deflation in this environment, you're talking about deflationary collapse, not like, hey, prices are falling, this is benign, we get a good deal. It's going to be like, nobody's able to buy and prices keep falling and nobody's able to buy out the sellers. And I think they're really getting close to that point here. You're seeing the breakdown across the world, and I'm sure the Fed's aware that they're close to shooting themselves in the head here. And so I just wanted to show this chart. They blow these bubbles up, but they can't fix the problem without destroying themselves. So I thought you guys would appreciate that chart.
All right. So they got for those of you that are just listening to the audio on this chart is showing that in the tech bubble, the Fed's funds rates were between 6 and 7%, and in the housing bubble, and where we had our great recession of '07, '08 into '09, the Fed funds rate was just over 5%. And now here, where the bubble has been dwarfing those two bubbles in as far as equities go, we're only at about almost 2.5% on the top of that bubble.
Yeah, and
So
that's one chart behind. So now we're at 3.25. So
right.
yeah, and so yeah, so 4.5% probably is gonna end this party for the Fed.
Right. So yeah, we started the base of this exponential move basically from COVID over to, and now we're under 1%. Interesting chart. Okay.
Yeah,
Next.
absolutely.
Right. All right. Next one is, I think we're going to discuss the PPI that came out today.
Yeah, I just thought people, in case they haven't seen it here, is that the PPI demand. Basically, it was um, the estimate was zero point 0.2. It came in at zero point 0.4, a little bit hotter. Ex food and energy, it came in pretty much at forecast but below before. Final demand came in less than last month, a little hotter than they expected, and then ex food and energy pretty much on. And you could tell by the stock market today. Stock market slightly up. There was nothing new in there to panic the market, and everybody's waiting on CPI to see if CPI is going to be just as benign from a forecast standpoint, and then we're slowly grinding down towards an acceptable, CPI print for the Fed to get themselves out of the corner they put themselves in.
Right. And for you guys that are looking at this, PPI is a little different than CPI. It's the cost of the goods being produced. So they're going to pass that increase onto the consumer. So that increase matters for inflation. And of course, everything's very sensitive to inflation numbers that come out, but not as important as a CPI number, which comes out tomorrow. All right.
Yeah, and one last thing I'll say about this is, obviously PPI is telling you more what's going to happen in the future than CPI, which is telling you what already happened. So,
Right.
and just so you know, anybody who's owned a business, just because your costs go up doesn't necessarily mean you're able to pass all that on.
Sure.
So PPI coming in is telling people out into the future that we're not seeing an acceleration.
Right. Okay. Awesome. Okay. The next chart is going to be this basically inflation pivot, right? Let's bring this up here.
Yeah, this is not a Fed pivot. This is inflation pivot. I thought this interesting because there was another chart I didn't bring on there, so I could just speak to it. Is that when the Fed pivots, when they actually pivot, actually lower interest rates for the first time, stock market falls on average 28% over the next 4 to 6 months. So it's one of those things. Be careful what you ask for or what you wish for. Is that you get a situation where the stock market will react negatively to that because they're assuming the Fed's always behind and we're going into recession. This is inflation pivot. So when inflation actually pivots, you'll see basically the S&P 500 profits collapse because basically these companies live on Fed liquidity, but also companies live on inflation. Why do you think the government always embeds a 2% inflation in there? They want the American people to always think we're growing as a country. Okay, it's a trick, and so if you have this mild inflation constantly running, it makes you look like, hey, I'm getting a raise every year. You don't realize all your costs are going up the same amount. And this is showing you here is that when he does slay the inflation dragon, it'll collapse S&P profits, which then would cause an issue with the stock market because it's going to affect cash flow. That's why the Fed, when they talk about they want inflation back to zero, but they don't necessarily want deflation, right? Because these things happen in deflation, which most people that don't own stocks and don't own a home, they absolutely want deflation. And and the Fed, whose employers all own homes and stocks, will never let that happen. So I thought that very interesting chart. I thought people would appreciate seeing the relationship between inflation and profit.
Yeah, that is a very interesting chart. So again, if you guys are just listening, the CPI just skyrocketed off of the COVID intervention stuff, and so did S&P profits. But as Bob's mentioned, their goal is to get it back to 2%. So disinflationary versus deflationary, because you're going to still be inflationary. It's just back to a more normal inflation rate. But that's going to basically hit the markets. And if we look at prices before the COVID, you could see it on the liquidity charts that we've shown you as well. We probably have a ways to go back down if they're able to successfully do what they want to do and get that back down to 2%. We kind of think that's going to be a tough hill to climb for them. Even maybe and this isn't uncommon, but they change the narrative after a while and say, well, maybe we need to get used to 3% as a normal inflation rate, right? So we'll see how that plays out. But in other words, look for more downside though in the markets unless something drastic happens and they have to re-intervene. Speaking of that, we are in a bear market, so I'm going to go over to the bear market chart. And basically what you're looking at here, this chart's from Tier 1 Alpha. It's showing you basically all of these lines here are historical peak to troughs, meaning how far did we drop from the top on all of these bear markets going back to 1927. And you can see that we're getting to the 200-day mark of this bear market. And we're only down, less than, we're over 20% in this bear market down from the highs. And that's obviously what they measure a bear market as is a negative 20% drawdown from the highs, excuse me. And most bear markets, or the mean reversal, is about 37% or so. So a couple of things to note here, and for those of you listening, we're almost to the 200-day mark, which means that we're probably going towards 300 days of a bear market. That's, and or longer. That's typically what happens when you exceed 200 days in a bear market. You're going to go out another 100 days at least, which is kind of in line with our view that we're really not going to see the end of this until Q1 or Q2 of next year. And then the other thing is that the decline probably would take us down to 3,000, believe it or not, if we follow basically your mean of all these bear markets, how they perform or underperform, if you want to call it that. So just I wanted to share this chart with you guys because it is pretty, it jumps out at you when you see it compared to all the other bear markets, and especially since we've gone this long into it. If we were going to turn the tide, we would have probably done that already. And the look here is that we're probably just going to have to be prepared for this not to end until next year. And then we'll do the normal things, but that's just wanted to share that with you guys, just kind of give you guys a heads up of where we're at historically when it comes to bear markets.
Yeah, the only thing I'll add to that, Phil, is that you typically get 5 to 7 up moves in a bear market too. So
true.
And so we really, we have probably 2 major ones, maybe 3 if you count a minor bump. So, there's 3 or 4 more moves higher to go here. These markets don't go straight down. And, everybody's like freaking out, at least in the world in which we live in. But if you look at this is a pretty benign bear market as bear markets go so far. And a lot of people are looking at 2008 and they're waiting for the cliff to fall. But people smarter than me that look at this data more, I would say, with more insight than I can, are saying that we're close to more like a 1940s kind of environment than even a 1970s and a 2008 environment, because this is a supply constrained bear market that we're participating in, and it looks more like what happened in the 1940s versus any other time period. So I'd encourage you to take a look at that. To me, I was never in the 2008 camp. I was always in the 1970s camp. And now I'm interested in trying to understand more about what drove this 1940s bear market, and to try to see if there's parallels, and also, what pushed us out of it so we can, position for the future.
Right. Yeah, in 1940 is interesting because it stopped short of 200 days, and I think it didn't quite get to that average drawdown of 37%. I think it was less than that, but that's an interesting comparison because we're nowhere near that level of drawdown, but we are coming up to that time frame. And I saw another. It was an idea that maybe we're like a 2002 market where there was nothing good. We had a terrorist attack, and then we had the dot-com bubble had completely bust. So there wasn't a lot of hope at that point in time in the market, but we came into October and we kind of double bottomed, and that was it. And we grinded away from there, which is a similar, you could make the case for that here. I just don't know what the driver is right now. GDP is contracting and the Fed's on an aggressive tightening cycle, which I don't think was quite the case back then. So that's more of a price pattern fractal, if you will, maybe comparison. I don't know if the under the hood is going to make that happen. We'll see. As you guys as we've shown you, liquidity is what drives everything. So I guess it's up to the Fed ultimately.
Yeah, we're good. And so right now, you and I we're talking. You're going to get this after the minutes come out. So we're actually talking midday here. The market's flat to up. Really interesting stuff. The miners have actually didn't dislike the PPI report, which was interesting to me, and we're actually getting people who use our service. Actually, we have a bot that looks at 4-hour buy signals, and we got some buy signals on some of the silver miners and gold miners here, based on the setup, and which is really interesting on a news day today. Usually they club the miners like a baby seal during these reports. So I'm waiting to see if we get follow through tomorrow, but the silver and gold markets might be sniffing out that the Fed's closer to the end than most people anticipate. So be very interesting to see. And with that, I'm done, Phil, so we can hop off, and then we'll be back at you guys tomorrow.
All right, that sounds good. Thanks again for joining us today, guys. And as always, if you could hit the like and subscribe buttons, that would help us out a whole bunch. And until tomorrow, have a great one. We'll see you then. Bye bye.
Thank you.
Trade Genius.